All right, so we are here for the Million Acres Hour. Every Tuesday at 2 p.m. Eastern Time, we get to talk real estate, my favorite subject. And I'm here with Matt Argersinger, our lead analyst at Real Estate Winners and Mogul. And today we're going to talk about hotel REITs, which is interesting, I think, right now, because we're at this point where things seem, I hate to be optimistic at this point, but I'm feeling a little optimistic. How about you, Matt?
I'm feeling pretty optimistic too, Deidre. I think we've all been surprised in a good way about how maybe how fast the vaccines have rolled out, and how early on in the year it was just, wow, this looks botched and it's slower than everyone was thinking. And now I think it's up to 2 million potential vaccines a day. I mean, it's really accelerating, and so I think that gives a lot of people, including us, optimism that by the second half of 2021, let's hope that everyone's traveling again, staying at hotels, going to concerts, going to conventions. And that's where things look like they're heading. So that's exciting.
It's true. I don't think that I talk to a person who doesn't have a laundry list of either the places they want to go, or the things they want to do, or the people they want to see. I feel like when you talk about pent up demand, I feel like there's just so much pent up demand.
Big time. I mean, you see some of the projections that have come out recently about the economic output for the United States. I mean, we were, I think earlier in the year we were tracking it at a 3 to 4% GDP rate of growth, and now all the estimates have come out that we're going to be closer to 6 or 7%. I mean, a lot of that's due to the stimulus that's coming out too, but I think it's also because people realize, the vaccines are out. Presumably life's going to get back to normal. And as you said, there's just so much pent up demand to do all the things we were doing before the pandemic that we haven't been able to do. And that's exciting, in terms of shopping, traveling. We'll get into it. But there's just, I think there's a lot of pent up demand. I agree. So good news for everyone. Good news for the economy. So.
Well, let's start by talking a little bit about REITs, because 2020, not the best year for REITs, but it seems like this year so far, things are really coming in pretty strong.
Yeah, let me share my screen, and this is always my moment of terror when I try to share my screen and it doesn't really work. There we go. Okay, so anyway, well, let's go into it. And by the way, there's our names at the bottom there. Deidre Woolard. Follow us on Twitter. I can guarantee you, Deidre is a much more entertaining follow than I am. I tweet very rarely, and when I do, it's usually about comic books or something silly. So, but yeah, let's talk about year to date, Deidre. This is it's interesting. I mean, this is. As of yesterday's market close. Now, I know the market's up quite a bit today, so a lot of these numbers are obviously changing. But if you look at yesterday's market close, the S&P 500, which is up about 2%, the Nasdaq 100, and we know kind of what's happened there over the last several weeks. We've seen a lot of volatility. A lot of those sort of high flying growth stocks have been hit pretty hard. So that overall index has come down quite a bit. But then you look at real estate. Wow, the Vanguard Real Estate ETF, which is a good kind of broad measure of it's the VNQ. I should put the ticker up there, but it's kind of a broad measure of the real estate market. Lots of REITs in that. It's up 3.2%, so outperforming two of the other major indices. And if you excuse the shameless plug here, Deidre, I love pointing out that our real estate winners recommendations on average are up 6.6% year to date. That's pretty exciting. It's also, the service is really outperforming since inception last September, but off to a really nice start. And this is what we were hoping when we saw a lot of those really, good valuations coming into 2021, and certainly the returns have followed through.
Absolutely. Let's take a look at some of the bad news first, because our next slide has a little bit of bad news.
Yeah, let's talk about some of the bad news. So obviously, probably I think we'll show probably the one property type within real estate that was hit the hardest by far, for obvious reasons. And I think you pulled some excellent data here from STR, Deidre. And if you look at the three sort of big metrics for hotel real estate in particular, occupancy. So occupancy was at 44% in 2020. And I think that's down 30. I think that's actually down 33 percentage points. So we went from, if I'm reading it correctly, 77% occupancy in 2019 to 44% occupancy in 2020. That is a huge drop. And if you think about the average hotel, I mean, it depends a lot of what kind of hotel it is, but the average hotel really only can't even break even on the cash flow basis until they're at 70%, maybe 75% occupied. So you can see most hotels, the vast majority of hotels were money losers in 2020.
Right. And that number even brings in the first, normal 3 months of the year. So, for much of the year, it was even lower. I saw occupancy rates, below 30% for a lot of the year for some hotels.
Right. Or certainly early on in
Mm-hmm.
March, April of last year. Gosh, I mean, there were hotels that were essentially vacant. Maybe they had 10 rooms out of 100 booked. It was really, really tough. Then we look at average daily rate, which is your room revenue divided by the rooms that were actually booked. And that was $103. That seems pretty low. And it was. I mean, it was down 21% during the year. Again, really tough. So, generally most hotels on an average basis are probably in the 130, 140. Your luxury hotels are in the 200 range for average daily rates. And that all came down, obviously, in 2020. And then your revenue per available room. Now, this takes the daily rate, the ADR, times your occupancy. So this is even a bigger tell, right? Which is what revenue did I make, across the board in terms of and based on my occupancy. It's not just my average daily rate per room that was actually booked. What was my revenue, per available room? And wow, $45. Really, really tough number there. Cut down by almost 50%. So really tough for a lot of hotels to make money in 2020. And of course, we saw the results in the stock market. You look, your average hospitality REIT was down, 20, 30%. I mean, it was in the early part of the pandemic. So March, April of last year, I saw hotel REITs down 70 or 80% in a lot of cases. You could have done some nice bottom fishing there if you were, kind of a scrappy investor. But even still, even despite a big rebound in the latter half of the year, still down, probably 30 or 40% from their highs in a lot of cases. So tough year.
Yeah, just that last stat that I thought was amazing. For the first time in history, 1 billion unsold room nights. I mean,
oh my gosh.
It's been so devastating. And, there's been a lot of talk about how many hotels are going to survive. And, it's looking better than it did in the heart of the pandemic. Because in the heart of the pandemic, people were saying, maybe half of hotels will go under. Doesn't look like that's going to be the case, but it certainly has been a tough period of time.
Yeah, that number is striking. 1 billion unsold room nights. So hotels essentially had 1 billion opportunities for people to stay in their hotel last year, and they were not booked. All right, well, let's shift to the positive, which is good. I mean, here we are in 2021. We certainly have seen signs of recovery. January occupancy and RevPAR were up from December, so that's a nice sequential second half of the year. I've seen this all over the place in the conference calls that I'm reading about how your hotel REIT is seeing such a big pickup in future bookings, which is a good lead indicator of how things will shape out for the rest of the year. And Deidre, this is a good one. I mean, this is when we're going to talk about kind of resorts and some of those hotels that really depend on conference bookings, but that is looking better, certainly for the second half of 2021 as well.
Absolutely. And I think everyone is really excited about the return of business travel. Most of what I'm hearing about conferences is that they're still going to be hybrid, but a lot of them are booking maybe not the same amount of room space they would have, 2 years ago, but at least some room space for in-person attendance.
Right. Well, I can't believe I read this, and I think it's true. I read it in a couple places that the San Diego Comic-Con in July is going forward as an in-person event. Now, I think they are setting obviously probably some occupancy limits there, but the San Diego Comic-Con is gonna happen. That's a huge event for the San Diego area. So that actually might be like the first big sort of nationwide event, a notable conference, I guess, that we'll see actually take place in 2021. So hopefully that remains true.
Yeah.
Well, and why is this happening? The health situation. We're seeing, widespread inoculations. We hear the bullet here says expected by the end of the summer, but I almost think sometime maybe in the earlier middle part of the summer, we could probably be in a situation where everyone who wants to get vaccinated, and gosh, I hope everyone wants to get vaccinated, is able to get vaccinated. And so that's super good news. I think it seems like it's getting better by the day. And then that, of course, leads to reopenings. We've already seen a lot of school districts around this country open up back up. Theaters are now open in most places to limited capacities. Museums are opening up. Concert venues are finally kind of booking dates in the second half of 2021. And this is one you found, Deidre, which is interesting, the sort of increased TSA traveler throughput. So we're seeing a whole lot more people take to the airways recently.
Yeah, that's a fun number to keep an eye on, is that the TSA publishes their throughput. And so you can really see over time, I mean, what happened last year and the numbers that it got down to during the height of the pandemic were startling. Now we're back over, around a million travelers a day, which is still low. But during the heart of the pandemic, you were seeing like 200,000 people or 300,000 people, which is just really, really low for travel in this country.
Oh my goodness. Yeah. So all signs point to, there is it's getting better out there. People are getting more confident, as they should. States and localities are kind of opening up and loosening restrictions. And so this is all hopefully getting to a place where we can all safely go out and kind of live normal lives, hopefully, really within a few months, which is pretty exciting. And that means a lot of good things for hotels and retail that we'll talk about. I love this chart, Deidre. This is one of those charts where I just geek out on. I could sit here and stare at this for for a long time. You found this. You want to kind of maybe give the picture here?
Yeah, this is from Calculated Risk blog. And if you don't follow that blog, it's a great source for information on real estate, the economy in general. He puts together a lot of interesting charts. And so this one just takes a look at hotel occupancy rates. And you can see at the top, the blue number is the occupancy rate for the past 20 years. Black numbers 2020, and you see that little hopeful 2021. It's like we're not quite there yet, but we're starting. I'm feeling like this is a pretty good little chart. We're starting to get. We're not going to get to where we were before the pandemic, instantly, but we're trending in the right direction.
Yeah, I love it. So I love the blue chart because you can see this is 20 years basically of median occupancy, and there's seasonality to this. I mean, you see how in the summer months, it sort of picks up and we sort of hit peak occupancy. What is that? The 31st month of the year. So, late summer, mid-late summer, and then, it naturally goes off. So that's kind of your occupancy, your natural occupancy curve. This is 2009, which I love, which shows, the last year where we had kind of a significant recession, but we didn't have a pandemic, but we certainly had a downturn. And you can see we were certainly lower than our median by a meaningful amount. But then 2020, you see this 2020 chart, and this is just extraordinary. I mean, that's just unprecedented in, this is what they'll write history books and economic books about. It's just this right here, which is so historic. But wow, a nice sharp, jump back here. And as you point out, 2021, now we're still tracking below 2009. If I'm a betting person, which I think I am, I would say this number, if we revisit this in 6 months, this red number has surpassed 2009. It might not get back to the blue line, or it might actually maybe by the second half of the year, but I certainly think it'll pass 2009. And so we'll have a slightly slower year than our sort of average. And that's because obviously we had such a, we're still sort of in the midst of this in the first half of the year. But I believe we'll probably be like, this red line will be like somewhere around here. In the back half of the year, which is really exciting. And so a lot of hotels that are just sitting right now on pretty precarious cash flow and balance sheet situations, that obviously is something you want to see, and I expect we will.
And you've got some interesting guidelines coming out from the CDC. So they've said that it's safe for fully vaccinated people to gather unmasked, which could be good for family reunions, short-term rentals, but they have cautioned against traveling for fully vaccinated people traveling, obviously, like in a plane or something with unvaccinated people. That is still considered risky. So my theory, and I think, last year I kept saying it was the Great American Road Trip. I think that's still going to continue this year, where you're going to see more people driving places rather than flying as much, at least through probably maybe half of the summer. So that's something to consider too, is how, where hotels are located as well.
Right. All right. Let's see what we've got on the next chart. So the next two slides, we're going to talk about, okay, I'm an investor. I certainly understand the macro situation, where we've been, where we might be going. Now I'm kind of interested. Okay, I want to learn a little more about hotel REITs and maybe how I can invest in in the hospitality side of the real estate market. And I think this is a pretty good breakdown right here. If you look at the types of hotels, the thing to understand is, what am I investing in? What kind of hotels is my REIT investing in their portfolio? And you kind of have, I'd say, 4 food groups when it comes to hotels. You got the full service hotels, your Hyatts, your Ritz-Carltons, your Westins, where there's a lot of attention on the amenities, things like room service and nice gyms, and most of these hotels have a full service restaurant attached to them, and there's a lot more built into that average daily rate than just staying at the hotel, staying in the room. So that's kind of one part of the market. And then you get into the limited service, which is your Courtyard by Marriott's, your Hampton Inns, maybe your Hilton Garden Inn, where used a lot by travelers, where I'm staying, and there's some amount of service. There's not room service or anything like that, but there's there's a small gym, maybe there's a pool for the kids to go hang out in, and you're sort of low to mid tier hotel option when you're traveling. And then you've got the budget hotels, like the Motel 6s or the Econo Lodges or the extended stay hotels, where very limited in terms of service. You're really just going there to stay in a room and do what you need to do, or an extended stay might have a larger room with a small kitchenette or something like that, where we're going to plan to be for a few weeks or maybe even a month or so. And then we've got the whole sort of different animal in this portfolio is the resorts. So you've got the REITs that are really focused on their destinations in themselves. People go there to enjoy the amenities. Maybe they're on the beach or near tourist attractions in cities, and it's a nice place to hang out and enjoy while you're traveling. You go there with a purpose, and so that's really a whole different business in itself. And we talked about some of the key metrics here in that earlier slide, but occupancy, average daily rate, revenue per available room. We're going to go through some nice case studies, comparing those when we talk about different hotel REITs. But these will all vary, depending on what kind of hotel you're looking at. For example, a first full service hotel, occupancy is important, but it's not necessarily the be all end all. You really focus maybe on average daily rate, because what's the revenue I'm generating per guest as they book in my hotel and they use my services, and they eat at my restaurant, they go to the bar, they order room service. There's a lot more that goes into it than just occupancy. Whereas your limited service or budget hotels, where everything's very streamlined, everyone has roughly the same experience. Maybe it's an occupancy game more. It's more of a scale game. And the resorts, of course, it's a whole bunch of different factors. And then Dieter, on the next one, flag, or I'd say brand, is important. Can you maybe expand on what is meant by that?
Yeah. So the flag or the brand is just what type of what the hotel is. Is it a Ritz or a Hyatt? And how many of each of those types of brands does the REIT have within it? Some of them have relationships with different flags, and some of them are sort of equal opportunity to have a bunch of different brands in their portfolio.
Yeah, and I think that's interesting, because most hotel REITs, as we'll see on the next page, they own the hotel, but they don't actually operate the hotel. It's operated under a service agreement or a franchise agreement with like a Marriott or a Hilton, or in some cases a Kimpton. So those are the ones who are actually operating the hotel and generating the revenue. And the hotel REIT is simply the landlord, the owner. There might be some operating percentage of rent that's getting paid, but they're essentially the landlord, not the operator of the hotel. And so if you go to the next slide, what are some of the advantages and disadvantages of hotel REITs? Well, advantages are if you own a hotel, think about it. I don't have long-term leases. I don't have a apartment tenant or an office tenant that's on a 1 year or 5 year or 10-year lease, and right. So I can react quickly. If the economy is good, I can raise my daily room rate, or I can adjust things. Quicker value-added opportunities. If I recognize an opportunity to improve something at the hotel, it's a lot easier to sort of throttle down my occupancy. Set aside some rooms to do some improvements or some other things. Much easier to do that versus like say an office landlord or an office owner that has, an office tenant on a 5-year lease. I can't just go in there and say, hey, guess what? I'm going to come renovate all the offices. So stop what you're doing, go home. It doesn't work that way. I can do that with a hotel in most cases. And then of course there are location advantages depending on what kind of hotel you're at. If you can position your hotel at an airport or near business centers where people are going for work or near tourist destinations, you can really take advantage of sort of natural demand drivers and natural traffic to those destinations. And so as a hotel, you can really sort of take advantage of that and really pinpoint where you want to try to be successful with your offering. But the disadvantages and the risks of hotels are really, compared to other property types, are really paramount. So, for example, you essentially have tenants that are on 1-day leases. It's that it can drive, as we saw in the pandemic last year, your occupancy can go from 80% one day to 20% the following week, and that's just because things change, and all of a sudden, no one's staying at your hotel anymore. That obviously doesn't happen in an office or an industrial or even a apartment building, which has tenants on at least 6-month, if not 1-year leases, or office tenants that are on 5 to 10-year leases. Like your tenant at a hotel is on a 1-day lease. So don't forget about that. More so than any other property types as well, I'd say the operator manager is crucial to success, like crucial. If you think about the property manager of an office building or the property manager of a apartment building, yeah, there's obviously some impact they can have on the success of the building. But hotel, it's a business. It's a daily, hourly business that has to be operated really well, efficiently. Otherwise, margins go away, and the hotel gets in distress, and then all of a sudden you have a tenant that can't pay its rent. So that's another disadvantage, is you have to have a great operating manager, and that's why a lot of hotels, as Deidre was mentioning in the previous slide, that's why a lot of hotels they hook up with a Marriott or a Hilton, which are great operators, historic, successful scale. They know what they're doing, and you can just I own the hotel, and it's managed by a Marriott, and they do all the hotel services and stuff, and I just collect my rent check, and that's where a lot of hotels decide to do that. Now, the amount of rent they're going to make is less than if they were, say, a boutique operator that managed their own hotel, but we'll get into that in a little bit. And then, yeah, of course, big disadvantage, which we've already talked about, is hotels are obviously more cyclical and seasonal compared to other real estate classes. The business goes up and down. If the economy's bad, hotels tend to suffer. If there's a pandemic, as we've seen, hotels can suffer historically. And then seasonally, if I'm on a hotel, actually, I'll tell a quick story. There was a case study I read a while ago about this can be so in Omaha, hotels in Omaha. Well, when the Nebraska football team was a sort of powerhouse football team in the 90s and maybe early 2000s, I don't follow college football so well, but there were so many hotels built around the idea that people were traveling to see Nebraska football. And so a lot of hotels sprung up, and they were obviously hugely popular in the fall when the team was playing. But what happened was too many hotels were built, and the team kind of fell off in its success. So Nebraska football is, not as successful as it was compared to nowadays, And so not only did that traffic still died down a little bit, but they had built too many hotels, and a lot of hotels in Omaha and the surrounding area kind of went under, which I think is fascinating. But so you can see, it's just location really matters. What are you building the hotel for? And then of course it can be very cyclical and seasonal, and you got to plan correctly. All right, let's go to the next page. Okay, awesome. Another table, Deidre, that I could just stare at for and be fascinated by for hours. What's going on here?
Well, this is from NAREIT, and this is looking at the different sectors of REITs and how they've been doing. And the lodging and resort REITs were up 23.91% in February. This was from the tail end of February. So we're just seeing a huge bounce back because they were down so far in 2020. And retail REITs have also gone up a bit. They were up around 12% for the month. So retail REITs definitely and hotels are all sort of part of that same movement of okay, there's some pent-up demand. These prices and these returns have been suppressed, and now we're kind of getting to a more exciting stage as we move through this cycle of the pandemic.
Yeah, and I love it. It's this table is just really a fascinating look at sort of market sentiment, right? Like, as you said, it's like, wow, they were so beaten down. Look at lodging and resorts; they were the
Hmm.
most beaten down REIT class in 2020, and so you'd expect a big snapback, a big bounce back in February, and year to date they're up really nicely as well. Similar story with retail. I don't know. Maybe retail is down even more, but retail has had a similar bounce back in February, and then year to date, it's just on fire. I mean, look at regional malls. I mean, how many times last year did we talk to each when we looked at the situation for regional malls, and we're just like, wow,
Hmm.
this is not looking good for malls, right? But look at the bounce back there.
And the interesting thing is too, you look at this chart and you look at the stocks the types of REITs that benefited during the pandemic. So data centers, for example.
Oh yeah,
So it's a little bit of a different story for them now, and that's just kind of the way the stock market works. Once it's like, okay, the things that we loved last year, those stocks that were related to industrial REITs and data center REITs. Oh, we need all of that stuff. They're taking a little bit of a hit
a
that they
breather.
don't really
Yeah.
deserve. Yeah, but it's a hit that they don't really deserve because there's nothing that's happened with those companies. It's a sentiment play.
It totally is. You're right. It's like dump the work from home stuff in February
Hmm.
because we're all going back to work or we're going back to school, and let's
Yeah.
buy everything else that got beaten down. And you see that perfectly in this table here. So very very curious to see if that continues. What continues in 2021? I like you said. I think when you talk about data centers or industrial, we've talked a lot, but just the secular tailwinds that those particular types of real estate have, not just in 2020, but where they for the next decade. If you think about, where the world is going and the needs for data and the needs for warehouse space, so one of the questions I think we're going to try to answer maybe during the show. It's a tough question to answer, but do you, as a real estate investor, do you go in and quote dumpster dive into REITs and retail, or I'm sorry, in hotels or retail, or do you stick with what's working and what's probably gonna work, almost guaranteed for the next many years, which is sort of your industrial and your data centers? That's a tough one. All right, let's go. All right, this is a colorful chart, Jidra. This is not great color. This is not what we want to see.
This is not great. This is not great color. This is a situation that is getting better, but it's been the amount of hospitality loans under distress. It's still a huge issue. It's been going down a little bit. It's closer to 20%, but that's still a huge issue right now. In fact, this week we had the Fairmont San Jose in California suddenly went bankrupt. Actually, the hockey team, the Vegas Golden Knights, were expected to stay there that night because they were playing the Sharks. They had to find a different place to stay. That's
No
how fast that
kidding.
bankruptcy happened. Yeah.
Oh my gosh, that's fascinating. Yeah.
And we've seen this. We've seen Ashford Hospitality has gone through this a lot. They've got a lot of loans on the books. They've already turned back in. Last I looked at over a dozen hotels, they returned back to the lenders. This is a huge problem that is, we're going to show later some of the distressed asset funds. This is something that we've been looking at for the past year and the question is, you talked earlier about that one day rents. So a lot of these loans, they can't make their money if they don't have enough people in the place. So the question is, how fast can hotels recover in order to resolve the delinquency status on some of these?
Right. And what's also interesting is for the next layer of this, which is you have a lot of banks who have obviously lended to these hotels, right? And they're not super excited maybe about taking over these assets, right? Because in a lot of cases, when a bank takes over an office building or another commercial property, the idea is, well, hopefully I've got enough equity in the building and I've got enough, reserves that I can, manage, sort of get a third party manager in there, turn the property around, maybe sell it hopefully soon and recoup most of my outstanding debt. Well, in this case, if you're a bank and you're looking at you have loans out on a hotel that right now is 40% occupancy, bleeding cash. Is this something I really want to add to my bank's portfolio right now? Rather than can I work something out with the hotel, with the operator or the owner and try to give them some relief knowing that I'm probably going to take a haircut. I'm not going to get paid maybe some interest for some time, and but maybe that's a better opportunity for me to recoup more cents on my dollar, so to speak. Those discussions have to be happening in a lot of cases, and you just wonder if a lot of the conversations are, well, we know things are going to get better 3 to 6 months from now. So if you can just help me hang on, like defer my interest, do whatever you need to do. Like let me sort take some of those principal payments and delay them until next year or something, or add them to the balance. Whatever the strategy is that can help me get through the next 3 to 6 months. And I'm sure a lot of bank underwriters are sitting there like, okay, this is a huge gamble, right? Is occupancy going to bounce back? Our cash flow is going to bounce back, or are we better off just cutting our losses and taking over the asset and trying to find a buyer? It's those are the things that are certainly happening behind the scenes here. But wow, that's not a pretty mountain there on the lodging side.
No.
So hey, we're going to talk. We're going to talk some REITs. We're going to talk a few examples. And why don't you give the rundown here, Deidre, on Apple Hospitality REIT? This is sort of they're not a huge amount of big hospitality REITs, and I think this is actually one of the larger ones, even though the market cap's, I want 3 to 4 billion there roughly.
Yeah, I mean, some of the hotel REITs are really sort of kind of exciting. This one is just sort of, it's what's interesting about it is it's the select service hotels, and that is things like where you have like a kitchen in there and things like that. So those are actually have done pretty well during the pandemic, partly because people wanted to have access to a kitchen. They didn't necessarily want to go to restaurants. So these actually, they work well for families that are road tripping, things like that. So the RevPAR is rising. You see that number there. And so they're definitely going to have an issue as they, as all hotels will, but they're definitely coming back. They reinstated their dividend. And because they are select service, they may come back faster.
Yeah, I think that you make some great points. And I noticed that their modified funds from operations of $20 million for the year, that's actually pretty good. I mean, your FFO, modified FFO, is essentially taking the operating cash flow of the company and stripping out a lot of sort of one-time expenses or not, and who knows what those are. Those could be meaningful, but at least on a going forward basis, like for like, Apple Hospitality's generating positive funds from operations, which is good. But yeah, this is, I'd see this is one that might bounce back faster. I mean, if you look at the bottom of the screen, we clipped this from the 2020 10K, and I think this is interesting. You can just sort of see the changes in the key 3 metrics for Apple Hospitality. You've got your average daily rates, steady 2018, 2019, of course, falling down in 2020. Your occupancy fell off the cliff as well, and your revenue per available room, gets cut more than in half in 2020. So again, just showing again how difficult a year it has been or was for hotel REITs. But this is interesting. I mean, reinstating your dividend in December, I would say, gosh, reading that headline would have made me think Apple Hospitality, either they're aggressive and bold and courageous, or they see enough. They have enough comfort with their balance sheet and enough sort of visibility, even though no one really has any visibility, but enough, I guess, expectations for things to improve, and that's a good sign. That's a really good sign.
Yeah, and they've been doing some interesting things in terms of consolidation. So they're trying to really focus on those rooms only hotels, the ones that are that select service, because they see that as a safer place to be.
Yeah. All right. Let's talk one that's really almost on the opposite. Xenia Hotels and Resorts. I hope I'm saying that right. So this Deidre is on sort of the opposite side. We're talking about luxury and upscale hotels in some really top locations. Absolutely.
So yeah, these are luxury hotels. You've got your Waldorf Astoria and things like that. They're in resort locations, and they're really kind of betting on that pent up demand. They're seeing an increase in occupancy. They sold 4 hotels. They're doing that same thing with consolidation. And that's something that we're kind of seeing across all hotels, is that we're seeing them pay much more attention to making just data-based decision-making. So like looking like, okay, which hotels are really performing, which ones aren't. they have a balance sheet that's, they're pretty solid. They've got some liquidity. So they're really starting to look around at where they can expand and where they can trim back. But really, they're betting on people wanting to travel and wanting to have, and the one thing that we didn't talk about is that international travel is probably not going to bounce back. And most of the brands that we're talking about here are US based and mostly US hotels. And I think that's a factor too, is that we're not going to see a lot of international, especially international tourism in 2021 or even 2022. So people still want to have that luxury experience, but they may have the money to spend, but they want to do it in the US. So that's also good news for Xenia. And, and this is also part of the other trend that we're seeing is that K-shaped recovery. We've talked a lot about that, is that, things like the stock market, that some people, we're seeing the upper middle class and upper middle class maybe have more disposable income and really be ready to spend.
Yeah, all good points. And I think what's really interesting here is if you look at the bottom again, and we see the occupancy, average daily rates, revenue per available room. So Xenia's occupancy, if I go back one, so you have Xenia's occupancy at 27% in 2020. So Apple Hospitality, much higher occupancy, much better occupancy. So a little more affordable, sort of on that value spectrum, right? But look at Apple Hospitality's revenue per available room, $51. Xenia, same thing. Revenue per available room, roughly the same. Xenia is able to charge average daily rates that are much higher. They can sort of get by a little bit better on lower occupancy. Occupancy is not necessarily that important to them as it is to an Apple Hospitality REIT. And so you have two hotels, two REITs on pretty much opposite side of the spectrum, but one has a much lower occupancy than the other, which is interesting for comparison.
Well, and also with something like a Xenia, you also have you're getting revenue from other sources too, because you're getting revenue from bars and spas and other services too. So that plays a role as well.
100%, exactly. All right, let's talk about another animal in our hotel REIT world, which is the resort. Now, when you think about resorts, obviously we think about destinations. People are going there not just to travel and be in that location. They're going there to enjoy themselves at the hotel, at the destination, and all the amenities that usually come with resort style hotels. And wow, Ryman Hospitality, right? So their occupancy's obviously been hit pretty hard. They're dependent on a lot of things. Like Apple Hospitality REIT is not, which is, if I'm going to Apple Hospitality REIT, I'm really just focused on booking rooms. Like I'm looking to stay at that hotel and do what I need to do. But when I'm going to Ryman, I'm thinking, I'm going to a concert, or I'm going to a convention, or maybe a big family reunion gathering at a resort. All these things that just totally got stopped in 2020 and are only now sort of trickling back into it. So really, I want to say, I might have this wrong, but I think Ryman Hospitality, if I can remember, got to like $15 a share in March or April. And it's bounced. I think it's like $70 now. It's almost back to, it might even be higher. The stock price might even be higher than when it was pre-pandemic, which I think is crazy. But
it's currently at $81.62.
Unreal. And I have to look at how low it got, back in last year, but what a bounce back.
I think the lowest it got was around, I'm just taking a look, around let's see, like around $21 a share was the
$21 a share. So it didn't go quite,
yeah.
It didn't go quite as low as I thought, but still what a turnaround. And so there you have people saying, oh, well, I mean, if Ryman's at $81 a share, you're thinking, man, the world is going to be back and beautiful by the end of this year. Conference bookings are going up, and they are. Like, you can see what's happening here from Ryman. I mean, the bookings have bounced back. 2022 bookings, which for these things, you for big conferences and stuff, you have to book them far out. They're in line where they were the past few years. So what Ryman's business is saying is that businesses and event planners are thinking 2022 is going to be back to where we were pre-pandemic, and Ryman's going to be a big beneficiary of that.
We have a question from Jen. Do you like Ryman at this price?
Yes, I will say yes, because full disclosure, it's an active recommendation for us in Real Estate Winners and our mogul service. And so I own shares. And yeah, I mean, what I love about Ryman is if you look at the historical performance of Ryman, going back, 10 years or so, and you see an extraordinarily well-run business. And what we like with Ryman, and I think Matt Frankel, who I know is cool live a lot, it's just some of the unique assets they have. You can't really replace some of the assets that Ryman has, and so that's a big reason why I like Ryman, and I think the market is recognizing that this is a company, a business, and a REIT that is going to do pretty well. Do I think the stock has bounced back pretty fast based on based on some optimistic assumptions about the rebound in hospitality? I would say probably a little bit, but hey, the market is a discounting mechanism, and the market says things are going to get better, and so who am I to argue with the market, right? Another one that's also in the hospitality space, and that is MGM Growth Properties. So we all know MGM. We know the casino and gambling company and gaming company, MGM, but this is actually MGM Growth Properties, which was split out from MGM, the bigger company, a little while ago. And MGM still is actually a majority shareholder of MGP. So MGM is in this business as well. But MGP is the property portion of the MGM business. Even though it's in the sort of the gaming and resort, it has gaming resort hotels and properties. It's merely the landlord. It's merely the company that owns the assets. And you could look at this and say, wow, well, this having a tenant, my exclusive tenant is MGM for most of my properties. That's both good and bad, because as MGM goes, so does my business, right? As MGM the tenant goes, good or bad, it's going to affect me as MGP, as the growth properties part of it. But MGM has held up pretty well, even though gaming and casinos revenues suffered in 2020 along with everything else, and people weren't traveling to Vegas or other places where MGM has resorts. The business held up pretty well. Obviously, MGM kept paying its rent. It's a not a blue chip company, but it's a very large company with very diversified, and so this is a way of attaching yourself to a great operator, the biggest casino operator in the country, and to bet a little bit, Deidre, on the growth of gaming, which we've seen expand tremendously in recent years, and it feels like it's picking up pace in a lot of cases too.
Well, it's also a bet on the return of Las Vegas too, and we saw this week, I believe it was Vici Group. I'm not sure if I'm saying that right. Bought the Venetian from Las Vegas Sands, and so we're definitely seeing a little bit of optimism returning to Las Vegas. Certainly, vaccination is going to be a huge factor there. Right.
Yeah, I think that's a good point. I mean, Vegas. Don't bet against Vegas. The saying goes. But I think that's true. I mean, before the pandemic, Vegas was one of the fastest growing large urban areas of the country. I think the population growth was growing between 4% and 5% a year. It was growing as fast as places like Denver and Austin, Texas. And of course, 2020 put a little hurdle in front of that. But I think it's a great point. I think it's a great way of betting on Vegas and the rebound there. But also, if you look at the business, MGM Growth Properties thinks their runway is pretty large. They're taking sort of a global view of things, and they think they can 10x their net operating income within, I want to say 10 years. So that's hugely ambitious. But so this company is looking bigger. They're looking beyond gaming and MGM. They're looking about being a sort of a worldwide resort company, and they're seeing a lot of opportunities in the market today. So one to follow for sure. All right, do we have one more slide? I think that we do.
We do. The last slide is just some notes I put together on distressed hotel asset funds, just because I kind of find this really interesting. We saw in sort of mid-pandemic, May, June last year, the beginning of distressed asset funds. And we saw this in a variety of sectors, but especially in hotel, because everyone is sort of looking at, okay, where can we capitalize? And so there's a lot of dry powder right now sitting on the sidelines, kind of waiting to pounce. I mean, you've got Barry Sternlicht of Starwood Capital, you've got Alex
A-Rod.
Rodriguez.
Yeah.
A-Rod's pretty sharp when it comes to CRE. You've just got a lot of money waiting for deals. And I think that's a factor too. What I've seen so far in commercial real estate is very low deal flow last year, but prices didn't really drop. And so there was just so much dry powder. Business Week has written about it a lot, is that like what happens to all of these funds if the opportunities that they were expecting never materialize?
Yeah, well, in a lot of ways, I think there's something to be said for what these entities are doing, because what they're seeing is a lot of stress. As we all see, they're seeing a lot of stress in this market. And what you'll find often is it's much more effective to go in and buy existing distressed assets than it is to develop those assets from scratch. Especially we haven't even talked about, we talk about this sometimes, but the cost of construction these days is wow. The price of lumber, it's the price of copper, it's through the roof. It's really, really expensive to build something right now. And so a lot of these companies are coming in and saying, well, rather than build something, it's much cheaper for me on a per square foot basis to go in and acquire existing assets, even if there's some risk there and it's distressed, but cash is cheap, capital is available. A lot of investors are interested in this. And especially when you talk about someone like Barry Sternlicht at Starwood Capital, they've been doing this for decades with huge success. They know when to get in and get out. Really one of the best operators in the market. And so they're seeing opportunity in this market. And I think that tells us as individual investors, hey, we should be looking for opportunities in this market. There is this expectation that things are going to bounce back. Valuations are cheap. And hospitality is a good business. It's cyclical and seasonal, like we talked about, but it's a good business over time. And whatever role Airbnb is going to play, as a competitor in that, we'll see. But obviously, these organizations and these managers have a lot of confidence.
All right, you ready for a few questions?
Oh yeah, always.
Awesome. Got a question about Vail Resorts. I know that's one you've been following. I was wondering too, if skiing is like we saw in the summer, golf got a big boost because it's a good social distancing activity. I feel like that's happening to some extent with skiing. And it looks like Vail is having a pretty good run as far as the stock right now.
Vail to me was lucky in the way that the NFL was lucky, right? Let's go back to 2020, right? We had the Super Bowl in early February, and then the NFL season goes out with a hitch. We have the Super Bowl, and a few weeks later, the pandemic really hits, and you see the NBA, who had, middle of their season, the NHL in the middle of their season, and baseball just starting their season, all have to shut their doors for months, right? Big damage, right? NFL was lucky by the not lucky, but I mean, they were able to sort of sit back for several months in the off season, figure out how to approach COVID policies. And they pulled off the 2020 NFL season, which is still amazing to me, by the way. Well, if you think about Vail Resorts, right? The ski season was just kind of ending when the pandemic hit last year, and wasn't really going to, and their business is so seasonal. It wasn't going to pick up again until, say, November of this last fall. And by then, they had time to put in COVID protocols to understand what kind of occupancy they wanted to have at their resorts to operate them safely. And the nature of skiing, as you point out with golf and things like that, is it's a bit of a solitary thing, right? I go to a resort with my family. We can stay, we can ski together. Everyone's wearing a mask anyway. It's a much safer activity to do than going to a beach resort or things like that. So I want to say Vail I feel like they just threaded the needle there perfectly with their business. They got very lucky with the seasonality in a way. And so skiing wasn't so affected as it was with other businesses. And then Vail's got a lot of other things going for them in terms of, off-season activities and things like that. They don't really depend on hugely, but again, people can go rent a condo at one of Vail's resorts, and it's a family knit activity that you can do things together with. And it's not, I think that was a huge benefit for them. And I want to say Vail's stock price is probably higher than it was pre-pandemic, which is incredible when you think about it.
Today it looks like it's around 307 that actually it is higher than the pandemic, than the last
Amazing.
peak was around just under 300 in like 2018. And of course at the height of the pandemic, it was down to around 131. So yeah.
An opportunity. Vail's such a great operator, such a great business, irreplaceable assets, as we know. And gosh, they've expanded. So, I mean, well, you know this, teacher, from being at Northeast. Remember Stowe? Did you ever go to Stowe up in
Yeah,
Vermont?
of course.
I mean, I remember when Vail bought Stowe, and I just was like, oh my gosh, there's nothing they're not going to touch. They're going to buy everything, you know. But it's what a phenomenal business, and yeah, I'm not surprised. Just given the nature of the skiing business and what that, I'm not surprised they've thrived through this global pandemic.
Well, and one thing I think that's interesting that has kind of changed the world of skiing is those passes, like the Icon Pass. That is a really big deal now. So Vail, I know they one of their earnings showed they had to discount because they couldn't. They didn't have the whole season, so they had to discount and give some people a lower price on their passes for this year. But those passes are a huge revenue generator.
Oh yeah, big time. I mean, it's in the same way that Starbucks sells gift cards, right? I mean, it's just so much upfront revenue that they deferred revenue that they can take advantage of, and yeah, that helps. I mean, they just have such a loyal base of people that ski on those resorts and those mountains every year. So they're just coming back every year to buy those passes again. It's a great business when you have assets that people love and a recurring business model that people love to attend every year.
JP is asking if there are any good hotel REIT ETFs.
We get asked about ETFs a lot of time, and I'm sorry that I have such dumb answers because I don't pay. I love investing in individual companies. I like to create my own ETFs, so to speak, and so I don't really invest a lot of ETFs. And I always get my boring if you're looking for a REIT real estate ETF, do the VNQ, which is the Vanguard Real Estate ETF, and it gets you exposure to hotel REITs as well. Not as much, but it's a nice low risk diversified way to play the REIT market. Deidre, do you know of any good? Yeah, I mean, there must be, but I don't know any.
There must be, but I haven't. I think there's some hotel ETFs. I'm not sure if there's a specific hotel REIT ETF.
That's a good point. Yeah, that's a great point itself, teacher. Which is, when you're investing in hotel REITs, remember most of the time you're not investing in the operator of the hotel. You're not investing in the Marriott or the Hilton or the Starwood. You're investing in the owner of the hotels, and so just something to keep in mind. That can play a role in what you're thinking. If you're interested in investing in the hotel business, you're probably more interested in investing in an operating company.
I've got a question from Jason about Matterport. Have you been following Matterport? That one is coming to market via SPAC. I'm sure you're familiar with what Matterport is. It's those 3D dollhouse kind of tours that are popular in residential real estate, but they're also getting into that sort of digital twin market, which is for commercial real estate.
I am getting old, so I'm totally befuddled by this, Deidre. I can't. I have no idea. It sounds interesting, though.
It actually is very interesting. I think the challenge for Matterport is being able to have that dominance on the commercial side, because they definitely have their residential real estate agents love to use it on the residential side. But the interesting thing is Zillow just they came out with a new version of their 3D app, which is used by both agents and photographers. So it seems like there's not anything that there's not anything that Zillow isn't taking a look at.
Yeah, well, they're the Facebook of real estate, right? Anything someone else is going to do, they can do it better just because they're bigger and meaner.
I don't know if they're meaner, but
no, they're not. Well, no, that's not fair. Not fair for me to say. But they have the eyeballs and the traffic and the scale that a lot of these smaller sort of niche operators don't have. And so yeah, they can test things more easier and get wins or losses faster probably than other operators. So and not bet their whole business to do it. So that's strong.
I've got a question or comment from Rania, who says, I'm on a flight at the end of the month to Florida, and both to and from are completely booked. Florida right now seems to be the destination of choice. Matt and I have two team members I know who have planning to go to Florida within the next few weeks. I don't know if this is partly because they're a little bit looser on the masking and the social distancing down there, but there definitely seems to be a lot, or maybe it's just we all could use some sunshine, but there seems to be a lot of travel heading to Florida right now.
Yeah, Florida's having a bit of a moment. I think there's just some really big inertia there, and probably it's people are getting a little tired of the cold at this point of the year. So Florida's that easy, cheap destination. And by the way, that's the thing. Like the flights still are relatively cheap, and but things are getting booked up. I think people are interested in going out and being in warmer weather and getting back to some kind of normalcy. So not surprised that Florida is a beneficiary of that. I think it's been there a long time. And I think I read that Disney World is also opening up, or at least it's a certain capacity pretty soon, or maybe that was their California.
I believe it was Disneyland. But
Disneyland. Okay. Has Disney World been open at all?
Disney World, I believe, has been more open than Disneyland. I think Disney World has been open at limited capacity, but Disneyland in California was been closed for a long time, and it is expected now to open in late April, which is
so that's
certainly
part of it,
great
right?
news for Anaheim.
Yeah, yes, and you said it, which is California's got different restrictions than Florida. Florida has less restrictions, and so that's just people that would normally maybe go to California or somewhere else are choosing the one where they have the least amount of restrictions.
Well, and that's one thing we didn't really talk about, but as we wrap up, that's something that is going to have an impact on some of these different hotel REITs and hotel brands, is that like eviction moratoriums, like so many other things that we're seeing by state, by locality, it just seems to vary. There hasn't been really universal rules on things, and different cities seem to have different protocols and different, we're in orange, we're in red, it changes all the time. There's a lot of confusion. And I think that is probably something that's going to, just be a little bit of a factor this year, is people are sort of drawn to Florida just because it seems like there's less of a hassle there.
Mm-hmm. Yeah. Oh, well, yeah, we'll see. We'll see. So you'd expect a state like Florida to bounce back, so to speak, faster, maybe. Let's just hope that health-wise and safety-wise, that doesn't mean bad things, for them in terms of, hospitalizations and things like that. Hopefully it won't, and they can open and be ahead of everyone else, and people can take advantage of it, which they already are.